What's up? What's up? What's up? Welcome back to the Deal Desk. Man, I feel like I am behind the times today because today's episode, we're talking about a story that I'm like, I just learned about. But it's like 2 weeks old. And in today's world, that's like decades of you're like decades behind at that point. Bill Ackman wired about $2 billion into a company that the market thinks is lighting up $135 billion on AI data centers, lighting them on fire. So the question is, why would one of the most concentrated and focused investors in the world, Mr. Bill Ackman, do this? He invested $2 billion into Facebook. We've just found out about it on February, or like earlier in February, but he started buying back in November. That's a pretty darn big investment. Braden, we got a good show today. I know we're a little bit late, yes, but we're going to have a good time. What do you think?
Yeah, this will be awesome. Super stoked for this one.
What? Braden, holy cow, look at you. Do you have a new backdrop?
I got a new backdrop, look at this microphone. This was just shipped to me yesterday, thanks to Josh the 40.
Josh the 40. Look at you go, dude. You got you're stepping it up. It's like you're going to be a professional podcaster here. Maybe
very well now.
Maybe you'll get the attention and Bill Ackman will come on the show. That'd be great if you could get him. I'd appreciate it.
Yeah.
All right. Well, we got lots to cover here today. We're going to be talking about, like we said, this investment. We're going to dive in. We're behind schedule a little bit. We're going to dive in. So I want to set the tone because what we're trying to do is we want to analyze and break down deals and deal structure. But more so than just that, I think one of the most powerful things that you can do as you're studying things is to look at the deeper things of what's happening, like the philosophy behind it, the person that is making those moves. Because when it comes to, really anything in life, you have the deal itself is greatly, greatly influenced by the people that are making them. And so when studying deal structure and going through and breaking down and analyzing things, it's important to look at also who is making them, because maybe you agree with their worldview, maybe you don't, maybe you agree with their philosophy, maybe you don't, but these things are really important. So today we're looking at a deal where Bill Ackman invests $2 billion into Meta. Some of the stats is Meta at the time when he started buying was down 16% and was trading at about 22x forward earnings. The market is obviously fearful of AI spending if you're just going to light it on fire, which the market thinks that it does. And that $2 billion investment is a pretty big deal. So let's dive into the story. And I want to go back and paint a picture of what happened and the players that are involved here so that we can dive in. Sound good, Braden? We good ready to rock and roll with that? Okay, so let's back. Oh, promise to the end of the episode. By the time we're done today, you're going to understand exactly how he structured his bet, what has to be true in order for it to work, and why this is not the same Ackman from a decade ago. Oh, because man, if you've followed him or know who Bill Ackman is at all, this is a very different man. And then finally, how to steal his capital allocation logic for your own deals if you agree with them. All right, let's back up. It is November of last year, and I mean, at the time, headlines very, very loud. Okay, Meta, which Facebook, right, the parent company of Facebook, is guiding for up to about $135 billion in AI capex, and analysts are kind of whispering around like, "Hey, arms race. Hey, this is the metaverse mistake all over again." Which, if you're not familiar with the metaverse mistake, Meta. They changed their name from Facebook, right, to Meta because they were going to build the metaverse, and the stock dropped like crazy because that bet did not play out so well. And so there was a lot of that whispering going on, right? A lot of analysts going out there saying, "Oh my gosh!" And if capex, I want to define that. Go ahead.
CapEx. That's what I was just going to ask.
Yeah. So capex is like basically the amount of money that a company will invest into like the future, right? It's not meant to make money now. And so they were allocating $135 billion specifically for AI investments that will pay off in the future, not in 2026, right? They mostly AI data centers, right? Like, and the market at the time, and still many people do think that that's not going to pay off well, right? That's going to be oversaturated. So you have this whole narrative going on. The AI craze, Meta's down 16% because of their allocations, and then they were down 16%, and their forward earnings were 22x, right? So not like a problem, not distressed, right? But also not euphoric and oh my gosh, this is incredible. So at the time though, in Bill Ackman, he lives in New York, and Bill Ackman is a big time investor. I think his portfolio is about 12 billion right now, 12 or 13 billion is roughly what his, and I think at one point it was like 15 or 16. I think it might be down just a little bit. And so he's back in November when this is all happening, he's sitting in his New York office, little known to most of us, building out a portfolio position, like making a play where he's about to add a huge amount to his portfolio. So you've got Bill Ackman, this big hedge fund manager who in the past has been quite loud, and his background is we'll get into a little bit more, but has been pretty publicly loud, but also has been laced with some, or has had his fair share of scandals. He was involved in like the Herbalife stuff with all that, and that whole debacle. So he's getting ready. This is back in November, like I said. He's getting ready to invest $2 billion into Meta. Now, the interesting part here is that he doesn't have to disclose this until literally 2 weeks ago, right? So this is all happening, and he's able to make this play without making a lot of noise, which is not typical Bill. Meta, on the other hand, is like we said, is people have their concerns about it. Not everyone agrees with their position of their approach to AI and looking at the past. So that's the context of like kind of where things are at when this deal is going down. Now, what's interesting is that I want to look at this through the lens of not like the public narrative for a second. The timing of this deal and how it goes down as it will play out, I think was probably a really big strategic part of his play, because when Meta had that big drop, it was like, the whole concept of like sell when everyone is greedy, sell when everyone's greedy, and when everyone else is fearful, you should buy. Like when you're going to allocate $2 billion into something, you have to have a deeper thesis in play, and like you have to kind of be waiting. And so while everyone else was looking at the kind of the narrative of AI is spending all of this money, right, in AI data centers, essentially, they're looking at it from one perspective, and Bill has to be looking at it from a different perspective. Got it?
Why do you think he was looking at it from a different perspective there? What's like the psychology behind that?
Well, I mean, if you study investors at all, I mean, and I think any successful person, like your lens of thinking has to be tied to principles. Okay, so Ray Dalio, wrote literally an entire book on this. He's one of the best investors, or certainly one of the greatest investors of our generation, or our time. And so I look at things through the lens of like physics, right? Or I think about things kind of like through the lens of like physics and truth and like absolutes of what we know. And in physics, you have this thing like of there's like a moment when right before something breaks free, right? Like when you're in orbit, like you're trying to get out of Earth's atmosphere. It's like right before the breakthrough is like the biggest part of resistance, right? The most pain, sucking the most out of it, and then there's breakthrough. And so I think that from that perspective, from a principles perspective, you have Bill looking at this deal going, okay, I agree with Meta's philosophy or I agree with like how Meta is going to capitalize on this, right? And how they're going to make money. And while everyone else is looking at it through how much they're spending, he's looking at it going, okay, well, if this thing can happen, if we can reach this point where I have this entry point and I think these things are going to happen, then bam, I'm going to enter in. And it's not even really about timing the market. It's more of like when the numbers make sense for where he thinks can escape that velocity and like get into release. Make sense? Okay, so because like at the end of the day, physics doesn't care about sediment, and it's all physics and that. So all right, so let's go in and break this down a little bit more. So part one, Ackman rotates money from Hilton and into Meta, betting on an AI enhancement compounding while the market questions Meta's spending. Okay. If you're going to make a $2 billion bet, and if I'm looking at deals where I'm going to invest, it's like, okay, well, where's the money going to come from, right? Because you have you as the investor or you as the deal maker, right? You have the other person or party or parties involved. You have the deal structure itself, like what it is that you're actually buying or doing the deal around, and then you have capital. And so Bill Ackman from the past was a very loud and kind of drew his fights out into the public, if you will, but and had a much larger, more diverse amount of holdings. But like if him today, it's only like he only has like 10 or 11 holdings across his whole entire fund. So if he's gonna make a play, he's allocating billions of dollars. That money has to come from somewhere, and so he's selling. Where that money came from him is he sold and rotated out of Hilton because he had a big position there, and when everyone else was worried about AI, at least around Meta. Actually, this is kind of interesting though. Now that I'm thinking about it, man, the way you prep it and the way it comes out are two very different things. Because if you look at, hold on, I want to check one stat here really quick. Most funds. Okay, yeah. So let me ask you, Braden, if I were to say what was investor and like public market sentiment around AI last year, particularly like late last year, like quarter 3, quarter 4.
Remember correctly, it's that people thought it was going to continue to grow, right? It's
Yeah,
like it's gonna blow up. It's gonna be huge.
Yeah,
It's gonna be
frenzy, dude. Market frenzy. Everyone is like, oh, AI, hot, all this, whatever. Now, there are some people that were saying bubble, bubble, bubble. And as we got later into last year, we got some bubble stuff here, but the money just kept pouring in and pouring in and pouring in. Okay. Now, if that was the case, then why is it that Meta how is Meta down? And it's like that right there is very interesting because, like, just because the market sentiment on a topic or a broader like narrative is one way, they can have a different sentiment or narrative around a specific company or a specific opportunity, right?
interesting. Okay.
So if you were to say who are the leaders in the AI race, would Meta and Facebook even be in the top like 5 that you would name?
They don't even come to mind for me.
Yeah. But yet they were saying, hey, we're going to spend all of this money on AI. But if Bill's philosophy, if you look at it from his lens, and he goes, wait a second, but Meta, like Facebook really isn't, like that, AI is not their business model. Like that's not what they're doing. The market doesn't look at it from that way. They're just looking at it from the headlines of like, oh, Meta says they're going to do such and such with AI. So the market can look at this and go, well, that's stupid. Like even though AI is doing well, we don't really think that that Meta is going to, like, they don't have the money. That's a stupid bet for them to play at the $135 billion that they're going to invest, right? Because like they're not an AI company, or they are, but they not to that level, right? But Bill's looking at this going, wait a second though, but that's not where the opportunity is, right? Like, cause like he's looking at it from where's my bet? Where's my play? Just because, and I think there's a takeaway here, okay? Just because everyone else sees an opportunity one way doesn't mean that that's where the opportunity is. Or just because everybody else is looking at it one way doesn't mean that's where it is. Another great example of this, okay, was Elon with Tesla. It's like everyone thought that the reason, like, what would drive people to electric cars and the whole narrative around electric cars back before Tesla was a thing was good for the environment, right? It was that you were going to go out there and the pitch to people was come drive a car because it's good for the environment. It's like, well, that is not what got people to come over. And then people thought that when Elon went and was like, actually, we're not going to take that approach. We're going to just build really, really great products. Everyone saw Elon go electric car company. And they thought, oh, Elon's goal is to build a car company. And it's like Tesla is literally not a car company, right? And so even though the whole public perception of the way something is labeled or the way that we look at something might be generally accepted by the masses, that doesn't mean that there's not massive opportunity in another direction if you can see it from a different perspective and want to make that bet.
Mean by Tesla isn't a car company for people who don't have that
Yeah.
perspective right now?
So Tesla is the market size of Tesla, the market cap of Tesla is bigger than all other US car companies combined. And if you look at it through the lens of a car company, it's like they're trading at stupid earnings. Like it's like it doesn't even make sense. But if you look at it through the lens of like a technology company, an AI company, a robotics company, a data company, it's like all of a sudden it starts to make a little bit more sense. And then you look at what they're doing and it's like, oh, they have the largest neural network in the world with Tesla and with their self-driving cars. So that's AI. You've got insane amounts of data and data processing from those cars. You have they're building robots, right? So you have robotics. Like they're a technology company, they're a data company, they're an AI. Like they're all of these things, not just a car company. But if you were to ask the average person, most people actually, is Tesla a car company? They'd say yes, right? So Bill Ackman is looking at this deal, and at the time, the market is saying, hey, the AI capex is excessive for Meta, right? $135 billion. Like, dude, what are you doing? There's no way. Social media is mature, right? That's what they're thinking with it. It's like that. There's no opportunity there. Regulators are a risk, and Meta burned trust with the metaverse. And honestly, that was a huge deal. Like Meta missed it big time, right? So most funds are chasing AI infrastructure plays, but Bill Ackman is going, wait a second, hold on. Yes, but that's not the only play with AI. The market, though, is just looking at AI infrastructure and go like the NVIDIA's, right? And going, let's put all of our money there. Meta's not a good bet. And from that perspective, it's not. But I wrote down this note. It was psychology hates visible spending, right? But power laws will reward scalable improvement. So the market is fearing that that Meta's going to waste all of this money. So what is Bill's perspective here? Bill's thesis or bet on Meta is that they're going to be able to use AI to make their ads model, which is their current monetization play, exponentially more profitable, exponentially better. Now, hold on to this for a second. Bill Ackman, who used to be this loud, noisy, like kind of all over the place guy, has gone from that to a much more, for lack of a better word, mature, seasoned like investor, very, very calculated place. Where's the money going to come from? He goes, I'm going to get out of Hilton. I don't see opportunity there. And I'm going to roll it into Meta. If he's going to put $2 billion into something, there better be an opportunity that he thinks is going to have substantial outside, asymmetrical risk reward here. And I'm like, okay, there is no way that makes sense inside of the AI lens, right? The AI infrastructure lens. So if Bill Ackman, again, if as a much more seasoned, very, very calculated, like few small positions person is making a bet that big, there has to be something that he sees that is going to get him an outsized return with it. And so we just have to look at what that is. And what that is that he believes that Meta's ads platform is going to be able to get so much better, and that the revenue that they're going to make from wearable products and from the ads platform is going to be the thing that delivers those returns. Okay? So does that make sense? Okay, good. 1 second here. Yeah, okay, perfect. Yeah. So let's stress test his philosophy here, okay? Hold on, I'm losing my notes. Actually, let's do it this way. First, I want to break down in detail the numbers of this deal from a market fears perspective. Then I want to break down the details of this deal from a what Bill Ackman sees perspective. And then I want to finalize it from a what has to go right, what has to go wrong perspective in order to see, so we know, like, if this happens, then he's right. If this happens, then he's wrong. Cool? Okay, so to understand this bet, you have to understand the old Ackman. Old Ackman was MBIA, Target, JCPenney's, Herbalife, excellent, event-driven and activist, public battles, brilliant but volatile. The new Ackman holds Chipotle, Canadian Pacific, Google, and now Meta. Fewer names, longer holds, less ego, more systems. He has shifted from this lens of I fix broke solutions to I own compounding machines, and really creating a long-term approach strategy. So if we look at the long-term approach strategy, or if we look at the kind of the collision of two narratives here, is you have this long-term approach, and then you have this immediate, like, revenue, headline, AI sentiment, market-driven narrative. And these two narratives are about to go and collide, and that's what we're going to break down. From the market's perspective, $115 billion to $135 billion is what Meta is going to have as a capex in this year of 2026. That's huge, enormous. Actually, the whole entire revenue of I should have this revenue of Meta last year. Revenue of Meta last year. The revenue was 48 billion. I think that was Q4. Yeah. Oh, no, $48 billion. Right? Is that right? Find out. I think it.
That's what I'm seeing on my end, but I'm going to double check it.
Yeah, okay. No, here it is. So revenue was $59 billion and $200 billion, representing 24% and 22% year over year for the fourth quarter and for the full year. So they made $59 billion in Q4 and $200 billion in revenue last year. In total revenue, they brought in $200 billion. They want to put $135 billion of that in CapEx on AI data centers. Here's what the market is seeing right now. They're going margin pressure, low free cash flow. We think that your bet may be wrong. Maybe we don't need those data centers. That's a lot of money on a risk for something that we're not sure if is really going to go and pay off. Couldn't you use that money elsewhere? Plus, you don't have a really good track record, okay, of picking like big time improvements. That's what the market is seeing. And so if I'm an AI investor and I'm looking at $135 billion CapEx on $200 billion in revenue, I would have some concerns too, okay? But is that, what we have to look at is that the only way to look at it? Is that their core business model? Because if you look at it from that perspective, it is a good deal. I mean, it's a bad deal. Now let's look long-term for a second. Let's switch over to Bill Ackman's perspective. Bill goes, wait a second. Facebook is a giant. They have a track record of winning. what's their business, a track long term, like since the beginning till now? But what did they win in? Yeah, sure, they lost in meta, right? But what did they win in? They won not in trying to build the universe and not the metaverse, and not by going out and building infrastructure. They won because they are a ad platform, a social platform, a way to, they own people's attention, and they're able to put that attention or put things in front of that attention that monetizes it. So like they're like a network, an infrastructure, an ecosystem, and a large majority of their revenue has come from their ad platform. So if I'm looking at this from a revenue perspective or an opportunity perspective and a business model perspective, I'm going, wait a second. If Meta's core business is owning people's attention, eyeballs, and getting paid by people who want that attention, and that's where they've won, is that going to be a good play moving forward? Is that business model or that opportunity still going to be needed, that service? Well, if you look at AI, and I got this wrong at the beginning. When I first saw AI all start coming out, I was like, oh my gosh, the service provider industry is going to be disrupted. Oh, and it was. But the second order consequence was, I was like, oh, if the service provider industry, the online space is going to get disrupted, then that means the marketing, the need for marketing is going to go down. Marketing is going to get cheaper. Everything's going to get cheaper, right? But that is not the case. In fact, Bill's looking at this and going, wait a second. If there are billions and billions and billions and billions and billions and billions and billions of dollars in the market, right? And a large portion of those billions and billions and billions and billions and billions of hundreds of billions of dollars currently right now go to software development, research, basically R&D, right? Research and development, software, and doing things that AI can now do, then anything that AI can do just got way cheaper, and all of those massive budgets now can go elsewhere, right? So let's say you have $100 billion in a market, or $200 billion, or $1 trillion, right? A huge amount of money that was going towards software development and coders and things that you can now do for 1/1000th of that cost. Before a company in the market is going to go and allocate money towards something, they're going to go, well, can we do this with AI? I mean, Salesforce, one of the largest companies in the world, now has like 50% of all of their software is written with AI. It's like their costs just got cut by immense amounts of money. Well, where's all that money going to go? Well, if everybody has software or access to software, then whoever controls the eyeballs, whoever can get in front of and sell to customers is going to win, because that's what's going to be needed. Your only differentiator, at least I believe, and it would appear that Bill believes as well, is going to be, do you control the attention of the buyer? Right? So if you have control of attention of the buyer, or you control the attention of the buyer, that is immensely, immensely valuable. I think we're going to see AI, or the cost to acquire customers, go through the roof, because you thought it was expensive to run Facebook ads already. Now, imagine when companies have 10 times more money or 5 times more money to be able to put towards advertising. Now you're competing with even more multi-billion-dollar budgets, okay? So that's going to start going through the roof. Does that perspective make sense? Okay, so now take that and sit down, and let's put ourselves back in Bill Ackman's shoes for a second. He's sitting there going, wait. AI as a technology is going to change the world. We know that. And also, all of the money right now in AI is going to the hype infrastructure narrative. But that's not the only place where AI is going to disrupt. AI is going to make things cheaper, is going to make things more efficient. Let's look at Facebook. Facebook has the ability to run or place advertisement, get products in front of people, run ads. They control the attention of the market. Not only does AI make that product immensely better, like it used to be so much more difficult to set up targeting. I would say probably this year, you're going to be able to literally just upload your product to Facebook, and it'll just take care of the rest. It'll do the creatives, it'll write the copy, it'll do the match, and it'll be 10 times better than anything we can do.
it already is kind of doing that. So like we ran Facebook ads the other like last week, and it's literally writing out 5 different captions for you, and testing them all different headlines for you. It's making AI related content and then actively testing it and using the one that is best right now.
It's like that's here already. Now imagine as you get more and more and more, as the market goes more and more towards AI, and it gets better and better and better, like how much better that product is going to be. And if you can get your product like perfectly matched in front of your ideal client, you're going to pay a lot for it. And if you're a company where your real only competitive advantage is your brand and owning, having the attention of your customer, you're going to be willing to pay a lot for that. So Bill sees that and goes, well, wait a second. Not only is Meta's ad platform going to get exponentially better because of AI, but also the more AI disrupts the industry, the more available dollars are able to go into paying for advertising. So it's like a double win for Meta, because if their advertising platform gets better, then people will pay more for it anyway. But if there's also like 10 times the capital or 5 times the capital going into it, it's like energy. Money is energy. And wherever the energy is flowing, right, money is going to follow. So if you just study where it's like, well, okay, where are people going to need energy? Where are they going to put their focus? They're going to put it where they can get the attention of their customer. Why? Because the customer has the money. And if the customer is willing to pay them, then they're going to stay in business. And so they're going to take that money, and the cycle is going to repeat. Who's the best positioned, or one of the best, arguably the best positioned platform to capitalize on an AI-powered AI-powered advertising? Meta. Okay? So while everyone else is looking at this through the lens of, oh my gosh, this is stupid, right? Why on earth would Meta invest all this money into AI data centers and processing when they don't even have an AI model that people can use yet? That's the narrative of the market. And from that perspective, it makes sense, right? But the masses, the narrative is almost always wrong, right? That's not where the opportunity is. And so Bill's looking at this going, the laws of physics say otherwise. And also, I think there's a crazy opportunity here to look at this from an ad buying platform perspective, from a business using AI to make their product better perspective, not a business selling AI. Are you with me? Okay, so Meta's AI isn't the product, it's infrastructure. It powers ads, recommendations, creative tools, assistants, wearables, things like that. So if engagement rises, for context, if engagement on Facebook rises like 3%, if conversions rise 3%, 5%, these are not like a couple $1,000,000. These are massive. Those are massive swings, right? Little incrementally better when you're at that scale has huge swings. So if AI or Meta is able to get better at targeting by 3% or 5%, there's lots and lots and lots of money to be made. Okay, so the market is looking at this deal as a cash burn from the cash burning narrative, because they're looking at the AI data centers, GPUs, and all of the infrastructure that Meta is building through the lens of AI as a product. Bill is saying, no. You're looking at it wrong. You got the infrastructure moat, because they have infrastructure that no one else has, and the attention of the buyers. The AI-powered ad engine perspective as the revenue driver, not as the AI as the product as the revenue driver. And the product expansion capability now, when you have that much more data on people for wearables and like things that like the Oculus thing, when you have that much data on what people actually want and are spending money on. So those are the two perspectives. And Ackman says, I'm going to be willing to bet that over the next 3 years, 5 years, 10 years, that Meta will win the game of profitability, will have succeed long term, because they're going to double down on that. And so he's willing to allocate a $2 billion risk, or $2 billion bet that's going to pay off. And so while the market is going, this is stupid, he sees opportunity. Now, again, just because he's like, okay, this is an opportunity, doesn't mean the entry point was hit. And so he did have, he did wait until it dropped. But from that from this perspective, I'm like, this was brilliant by him if it pays off. Cool. Okay, so what has to happen? What has to happen in order for him to be right? Number one, the AI has to improve the ad yield. Meta generates about $100 billion in ad revenue annually. So if AI improves target precision, increases conversion rates, and optimizes auction pricing, then even a little bit of improvement yields a big deal. So that has to happen. Otherwise, he's screwed. Next is AI assistance and impressions, like the use of AI to assist in decision making and driving consumer engagement must increase the engagement. Because otherwise, if people aren't engaging more on the platform, then it's harder to go and get them to buy more because you have less of their attention. So number one, the targeting has to get better. Number two, the assistance of AI and AI assistance on the platform has to drive user engagement up across their platforms. Third is that wearable and edge devices create platform leverage, meaning the Ray-Ban, you've seen those Ray-Ban glasses? Like stuff like that, the Oculus. That has to be a play to keep more of the attention because they have to branch out into other avenues, because right now the only place that people are seeing it is on like the phone, right? Well, I mean on the computer, but
is with those wearables is they're expanding where they're getting data for AI to collect as well. So what's crazy about that is they have tons of data for online, like what causes somebody to buy. But now they can, because they have cameras in it, they can see, okay, where does this person go? And they have all the background information on them and on their psychology, and they can collect data on like real world buying decisions. And if they almost grabbed an item in a store, for example, and then they decided not to, there's a ton of opportunity there in the real world too.
yes, like the collection and analysis of data. Also, it's platform expansion, because if you have Oculus now and you have the Meta ads, you can show ads, or the Meta Ray-Bans, right? Like you can show ads there as well. Like wearables, right? So basically, it's like, okay, is AI going to disrupt stuff? Yeah. Well, what's it going to disrupt? Well, it's going to disrupt all the software. So it's going to make the product of Meta's actual business better. Cool. Well, in order for their business to get better, what has to happen? Well, it's got to. I mean, in order for the business to get better, what has to happen? Number one is the targeting has to get there. Number two is the amount of time that people spend on the platform has to go up. So targeting first, then the amount of time. Third is the collection of data, right? What you were talking about has to expand. They have to be able to collect and process more data. And then fourth, there has to be platform expansion, because that's going to drive up the amount of time that people can spend on. That's going to drive up the amount of data that they can collect. And it's going to drive up the amount of ads that they can run. So if you think that that's going to happen, then this is a crazy outlandish bet. If you don't, then it's wrong. Because $135 billion worth of investments into AI data centers and infrastructure, like that has to have some crazy, crazy upside. But if all of that processing power is not going to making images on Grok or consumer compute, but rather is all concentrated and focused on ad targeting, on data collection, on increasing engagement, on platform expansion, all of that power is concentrated there, yeah, it could have crazy upside, right? So that is where the opportunity is, and that's what he's betting on. And if those things go right, then he wins. What could go wrong? Well, ask Meta about the metaverse. I think that probably the biggest, I mean, this is just my personal opinion, is that the biggest risk that they have is that the return of where they're going to invest, like they're investing in data centers, and those take time to build unless you're Elon Musk, right? That the return from those, because the market is moving so fast, lags because of the amount of time it takes to like build and getting them up and working. Because even though they would use all of this for their platform specifically, like the market is moving so fast and there's so much changing that by the time you have, like when you're building real infrastructure, right? It's like by the time they have that up and going, and then the time that it takes to actually produce an ROI from that and get your money back, like you have no idea how much more efficient stuff is going to get. And so I think personally that the time, it's not that it wouldn't be possible, it's that the time it takes for it to happen could be too long. Does that make sense?
Yeah.
The second one is, and I think this one's a real issue as well, although I don't see how long-term people get around it, is regulation from the government to limit the targeting of ads. Like that's a real threat. Because if the government basically says, hey, this is an invasion of privacy, and puts regulations on how they're able to target, that's a threat as well. The other one would be like sentiment turns negative again, poor timing, right? Like narrative it changes all the time, but it really affects things. Huh? Yeah. And then the return on their capital investment drops below the cost of capital. Like if they raise $100 billion and they borrow and invest $130 billion, there's cost on that money, the interest, right, and what they owe back investors. So if the slowing of slow returns from a delayed investment, like delayed return on investment, if the regulations from the government, if the sentiment from the market of where people are putting money, if like AI becomes like more efficient and there's not as much money as they thought coming in, and all of a sudden now their cost of capital is more than what they're bringing in, like that could be a problem as well. Do I think it's going to knock AI or Meta out of business? No, but for Bill Ackman's bet to be wrong, those are all like super valid concerns. But, I mean, really, from like a money, like an opportunity perspective, from a psychology perspective, I mean, I'm just looking at this from that and going, there's so much money that's going to be flowing into advertising. There's so much money that's going to go, it already is flowing into it. We talked about it on the show last week. It was like, billions and billions of dollars are being raised and are going into discovery and distribution platforms. What's their faces? Substack raised $100 million, mostly for discovery and distribution, right? People are spending more than ever on paid subscriptions. Like attention is just going to go, the cost of attention is going to go through the roof. And Facebook literally is the biggest platform in the world when it comes to social attention. And like, I don't know. I think that's a safe bet. Or at least a bet worth making if you're going to make a bet like that. You know what I mean? So that's what has to go wrong. And could it happen? Absolutely. But so yeah, that's the bet. That's the deal that is going on right now. I think one of the things I do think is interesting though, as well, as we kind of go into more of a philosophical like point of view for a second, is it's interesting to watch the growth of Bill and how he's evolved, right? Because you think about him as used to be a very loud, a very like noisy center of attention, public event, like always capitalizing on events, like hype stuff, much more that driven, into more of a a very long-term approach. Like there's a philosophical play to this as well, because Bill would not have made this bet. Like old version of him would not have, because like the sentiment's bad, right? Everyone right now is being like negative. Like he would not, he's literally going against counterintuitive of the entire market's perception. And so it's interesting as he has become, more and more successful and seasoned off. that the bets that he is making, like he clearly is thinking about this from the next 10 years perspective, right? Or like a much longer term than how can I get in, capitalize on something, make a bunch of money, and get out. Because that this bet is literally opposite of that. And I think that there's something to that when it comes to your approach to doing deals. Like for example, if let's say you do a deal and you could go into it with the approach of how do I maximize my profit on this deal, like free cash profit by the time the deal is done. That is an insanely different approach than if I'm walking into a deal and going, I'm willing to get almost no profit on this deal for a very long period of time, but I want ownership, right? I want to own the asset. And there's nothing wrong with one or the other, but they're very different approaches. And it also signals like your philosophy or like like how you operate and what you believe about whatever the market is or whatever the industry is that you're going into. Because why on earth, like let's say there was a huge opportunity right now for, let's think, what's a good one? Like, okay, like technology or like device, like, you know how like Apple will make like a new phone or a headset or something like that. And then there's all of the phone cases and gadgets and like supporting things that go along with it.
Ecosystem around that.
Right. Okay. So let's say I was going to go and do a deal and I was I saw an opportunity with the iPhone 17, the new iPhone that was coming out, right? And I was like, you know what? I think that this orange color trend, right, of the new iPhone, like I think that that's going to be a fad. Okay? I don't think that these colors, this type, like, is going to. No, that's not it. People are going to go more towards that's a trend that's going to go away, and they're going to go back to more of like bland, like black colors. That's going to be the primary thing. Well, if you thought it was going to be a trend and you're a phone maker, a case maker, or you were involved in that, you would want to structure deals where you got as much profit out of making or investing in these things as fast as possible while it was a trend, right? But if you thought, man, no, people are getting more and more expressive and creative, this wasn't about just being like a different color. It was a status statement by Apple. Apple is going to continue to do status statement type of things, and orange being one of those colors. There's going to be other future colors that make these cases and these cases become. I'm going to bet on the fact that people are going to have more than one phone case. They're going to want multiple of the phone cases in many different colors because these are like status statements or things. I'm going to go and I'm going to take ownership, or I'm going to structure the deal to where over the next 3, 4, 5, 6 years, I'm going to, I want ownership of the company rather than profit now because I believe the value of that's going to go up. Those are just two very different approaches, right? So Bill's making the long-term one when it comes to Meta and AI specifically. And I think that that's cool to watch that evolution with it. And as I've grown in business, I've noticed my perspective and my approach and philosophy change. And I think that's kind of an interesting evolution. So anyway, okay. So as we wrap this up, I was very fascinated by like just this whole deal because it kind of took me off guard. I didn't think that like when I saw Meta, I was like, wait, what? What is he seeing? And when I kind of dove into it, it was clearly that. To kind of put a pin on all this, the real bet here that he's making is that he believes that the market has overpenalized visible AI spending from Meta. And in a business where smart AI-driven improvements across billions of users create an enormous amount of compounding returns, that they've been overpenalized enough to where he can have outsized returns. Based on his entry point right now. Like, that's his thesis. And what he's betting on is that this is a bet of influence and a bet of attention. And if the value of influence and the value of attention and the value of having extremely targeted attention continues to go up, he wins. If it doesn't, he loses. Cool? Okay, that is, I think we end it there. That's all for today. Tomorrow, we've got the Bitcoin and Jesus weekly segment, which will be super fun. We have a couple different topics that I want to cover on it, and I haven't picked which one yet, so it'll be fun. I have an idea, but if you want to look at things from a little bit more of a philosophical Bitcoin and Jesus perspective, tomorrow is a really good episode for that. Otherwise, yeah, we'll see you guys tomorrow.